We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Gareth Soloway, President and CFO and Chief Market Strategist of InTheMoneyStocks.com. Thanks for joining me today, Gareth.
Thanks for having me back, Tom.
Of course, always great to speak with you and talk markets. So obviously at the end of last week, we saw some big drops in the general equities. So I want to start by getting some ideas of how you react in a situation like that.
So I think the number one thing is, as a trader or an investor, you don't want to let panic and fear take over, right? So just like you don't want to let greed take over when the markets just seem to go up forever, you don't want to buy at the top. You also don't want to let that panic come in. So, when I saw the drop on Friday and we know about the new variant that was coming out in COVID, you had to be aware that the markets tend to sell first and ask questions later. And sure enough, by Monday, we had the whole weekend to digest it. It definitely is a concern, but was it worth that big of a drop on Friday? The markets aren't telling us that at this point. So, I think the markets are telling us they're vulnerable to these black swan events. So we have to remain vigilant and aware that there is risk out there in the markets because things are so lofty in valuations. But at the same time, the buy the dippers came in again on Monday here, and we've seen a very, very big bounce.
Mm-hmm. I want to kind of get your thoughts on how these news pieces affect the markets here. Are there any other, external factors or announcements that you're watching for before the end of the year that are likely to cause more turbulence like this, ones that we can see coming?
Yeah. So like you said, the ones that we can see coming are the ones that the market can prepare for a little bit. So it's more a matter of, for instance, the Federal Reserve, if they decide to taper faster than anticipated, that might be something that the market's not prepared for. So I think that's what we want to watch for in December going into year end. I'm also curious about if there's any new developments in terms of new laws going into effect or tax hikes in 2022, where investors might say, hey, listen, I don't want to risk paying a higher, long-term capital gains tax. So let me sell into the year end. Everyone was calling for this end of year Santa Claus rally. And one thing I've learned in the history of my trading is that when everyone's saying something, you want to be a little cautious. And again, it just means that everyone's in that direction. So the markets inevitably want to go the opposite way just a little bit. So I think the Fed, number one, I think that, again, the markets are heavily levered. And that does make for these big drops like we've seen in the stock market, where you can see 2-3% down days in a split second.
So since the last time we spoke, we saw inflation numbers come in much hotter than expected. We saw the Fed announce their tapering plan. And I just want to get your thoughts on how you see the Fed affecting the general equities at this point. Have investors just really learned that no matter what, you buy the dip, even if, after you see even a 10% market drop?
Yeah, they have, right? Because if you look at COVID, the COVID collapse of 2020, we were down 20 to 30%. And I mean, how fast did we recover? So the market honestly doesn't believe that the Fed will ever continue to have a backbone. I mean, it's one thing to say, hey, we're going to taper by 10 billion a month or 15 billion a month. The markets don't think that the Fed will continue to be on that path for the long term. They think that as soon as the markets have a hiccup, for instance, what we saw with this new variant on Friday, we saw interest rates collapse, which told you that the market was anticipating the Fed stepping back because of this new variant. So again, you can only go for so long in a market without something occurring. And every time in the history of this market in the last 20 years, something has happened, the Fed has basically stepped back, reinflated things, printed more money. So the market has no basis to think that anything in the future would be any different. So it's really this lack of, belief in the Fed having a backbone that is making people think, hey, I can buy on every dip, 2% dip, buy, 3% dip, buy, 10% dip, and just buy because it'll go right back up. And that, I have to say, is very concerning. Mm-hmm. That is something that as an investor, it starts to raise alarm bells because people aren't making decisions on valuations. They're not making fundamental or technical decisions. They're just saying, hey, it's going to go up. I can sell it to someone else higher. And that's the way they're feeling. And that is not a good way to invest.
So how does that play against their dual mandate? On one hand, we see them trying to talk about tapering, trying to get away from that. And yet, on the other hand, their behavior in the past has shown exactly the opposite, right?
Yeah, and that's the tricky thing with this dual mandate, right? And I've gone on record as saying it's one of the biggest fumbles in the history of the US is when Congress gave the Federal Reserve the dual mandate. Because early on, prior, it was all about, okay, you guys as a Federal Reserve monitor the money supply, make sure things are working properly, make sure that inflation doesn't get out of control. And then in 1977, they're like, hey, well, now you guys have to pay attention to unemployment and make sure unemployment stays low. And the problem with that is that, basically, if the Fed has a backbone and steps on the market to kind of say, okay, well, we have to cut the inflation side of things and we have to be firm with the market, well, then what happens? The markets drop and unemployment rises. And now the Fed has to react and say, well, now we have to make the market go back up because we need unemployment to come back down. So it's this weird dichotomy where the Fed is just in this box about, well, which one? Do they have to be the strict parent on one hand and be firm so inflation doesn't get out of control? Or do they have to be the easy parent, the parent that spoils the child so that the unemployment rate stays low and everyone has jobs?
Mm-hmm. Yeah, it really just makes it seem like there's no, it's almost created the opposite of a free market now.
That's exactly what it has done. And I mean, I actually looked at the interest rates from the time. So if you go back to 1977, interest rates were basically at their highest point. And then since that dual mandate went into effect, you see like this stair step down. It's just like continues to go lower and lower on interest rates. And if we continue on this path, we will see negative interest rates at some point in the future. And you could understand why, because at some point, another crisis comes. The Fed has to then come in and print more money and lower interest rates to re-stimulate and bring that unemployment rate back down. And eventually, where else are you going to go but negative interest rates? Now, eventually, the whole system collapses. That's kind of the worst case scenario, but that's the direction we're on at this point.
That was actually exactly where I wanted to go next, Gareth, was to interest rates. So you mentioned before that the Fed is basically stuck in a box here. Yeah. Do we ever actually see a meaningful hike in interest rates, or is it going to be a nominal hike in interest rates before we see the market panic and them step back from any of those actions, whether it's cutting more QE and actually trying to raise interest rates, or any of those actual reactions?
Yeah, I would say that you're never going to see a major increase in interest rates. I mean, again, I expect interest rates on the 10-year to maybe go to 2.25%, maybe 2.5%. But historically, that's nothing. So again, you have this much, you have so much U.S. debt at this point. You can't let interest rates go too high or the country will go bust anyways. And so you have to keep the interest rates low. Eventually, you have to devalue the dollar. So, I mean, it's this crazy bind about, okay, well, how much do you let inflation go up where it hurts the middle income and lower income groups in this country versus, well, how much money do you print and how much do you stimulate? And it is just this mess that they have created. And it's done to kind of please the short-term political scene. No Fed official, no Fed chair wants to be the chair that caused the massive collapse in the economy. So they kind of say, okay, well, let's do what's easy in the short term, just like our politicians, right? Every 4 years, there's another election. So they're not focused on getting this country on the right path for the next 20 years. They just want to do what makes people happy for the next couple of years so they get reelected. It's a very bad policy for the long term, but it's what human nature is right now.
And a lot of what you're doing is just basically analyzing raw data of human nature. So why don't we go to some charts, Gareth? Why don't we start with, let's say, the S&P or the Nasdaq? You and I were talking before we hit record here about this channel that we've seen the Nasdaq and the S&P both kind of trade within, right?
Yeah. And really amazing how charts work, folks. For those of you watching that, haven't really looked at charts, you have to just marvel at how a market like this can stay inside of this channel. And look at how this upper trend line, every time it hits this upper trend line, you see a drop, a pullback of sorts. You can see how the market on the S&P has gotten up to it. It's hovered right there. And every time it touches, like we just had a recent hit here, and then you had this pop making a new all-time high, which basically kissed that line that led us into Friday's decline. Now we're bouncing back. But as a trader, I really follow these because it gives you a good sense when the market's going to sell off. When do you pair longs? When do you potentially short the market? And then on the opposite side, if we sold off down to this trend line down here, you can see how here it hit and bounced. The same thing goes for the NASDAQ. Absolutely amazing. The difference with the NASDAQ here is that the tech sector is more volatile. So you've seen more hits of the low end of the trend line, versus the S&P, but look at how it works amazingly well. Like here was the last hit, and it led to one of the biggest, shortest, fastest runs in the NASDAQ that we had seen. We went right back to that upper trend line. We then pulled back. We pierced it. We again pulled back. So the markets are being held inside of this range. And at least in the short term, as long as you stay within this channel, you will be okay in a market. It's still technically in an uptrend. What I would mention is that at any point, if you break below this lower trend line, that's where you would break trend. And that's where we could be at the start of a bear market. So if you're an investor out there, you could just say, okay, I'm going to stay long as we stay in here. Even if we pull back, as long as you hover above this trend line or hit it, you have to assume a bounce. But if we break below, be really, really careful at that point. That would be where you would start to say, okay, I'm going to move to cash, or I'm going to be in gold all the way. Those type of investments would be wise at that point.
So that was my next question with that, Gareth, is, when we look at that, and you mentioned, short term, you're looking at that lower trend line. If we back out and take a longer term perspective, do you have any tools that can tell you, where we might see a reversal or what that reversal might be?
Yeah, I mean, that is like the trickiest thing in the world, right? Of where big one, it's easy to kind of predict when you have a trend line like this. Okay, you pull back off of it here, and then you do it here. Those are very short-term pullbacks. Honestly, I'll just tell you guys that, the last few times we've hit, I've said, okay, this should be the top, where it's a multi-month, multi-year top. And then the markets have proven me wrong in the short term. So, I think for us as traders, we have to kind of accept that this is the range. We've been in it for a long period of time. What we want to look for is when we break this lower trend line, then I think you can go out on a limb and say, okay, we might have a multi-month, multi-year high. We could be in the process of a 20, 30, 40, 50% correction in this market. And obviously at that point, it's more than a correction. But right now, again, the markets are just loving this channel. Perfect parallel lines, keeping the market in check. And by the way, this is partially algorithms trading, right? I'm sure algorithms are programmed to sell the high and buy the low on this channel. And also just human psychology. I think up at the upper line, you have max bullishness, which then dictates a reversal. And then same thing downside, people are finally starting to get scared, which enables the buyers, the short, you have some short covering down there and a reversal to take place.
So you mentioned, in a bigger crash scenario, you move all to gold. Or cash, whatever assets. What market or what conditions would make you move in that direction, Gareth?
So I think you definitely follow interest rates a little bit. I think interest rates have to be monitored. The market starts getting skittish anytime the interest rate on the 10-year starts getting close to that 1.75% high. I also think that you have to pay attention to geopolitical events. Any sort of Chinese movement towards Taiwan is definitely a concern. The Russian buildup on the Ukrainian border is a concern. I mean, those things may not turn out to be big events, but there are definitely potential for black swan events there. And then I think bottom line is you really want to follow the dollar. What is the dollar doing? Look for bigger moves in the dollar that could really put pressure on the system and potentially break it, if you will. So I think there are lots of things as a trader, as an investor, you want to follow. A lot of them have to do with the Fed and the interest rates, though. I would say that's the primary thing that I'm watching. With economic news coming out multiple times a week, you want to follow the interest rates. What are they doing? And then notice how when interest rates pop, dividend stocks tend to do better. So AT&T, really cheap PE, pays a nice dividend. Those type of plays you'd be interested in, while technology like Tesla, those tend to sell off when interest rates spike up.
So in that scenario, that's what we kind of need for gold and silver to start to have some momentum again, right?
Yeah, I think the biggest thing that you're watching, so with interest rates, it's really tricky, right? Because interest rates historically, at least over the last 20 years, when they go up, gold actually sells off. But you could argue that that's starting to break a little bit because inflation wasn't an issue for the last 20 years. So that inverse relationship held true. Now you're seeing inflation be the cause of interest rates going up. And that then creates more upside for gold in an interest rate environment where they're moving higher. So I do think you're on the precipice here of upside in gold. I've been, basically, I think every time I've been on with you, we've talked about how I am bullish on gold over the next 12, 18, 24 months, because I just keep on looking at the fact that the Fed may taper, but we know that it can't go on for that long until the next black swan event hits, and then they start printing again. And the inflation side, yes, you have a supply side issue, but there's also inflation based on a lot of other factors here, including the money printing, the debt, and everything like that. So you have to be just longer term bullish gold. And one thing I'm watching on the GLD chart, here's a GLD chart, right? This trend line right here is a chart, I think a trend line we talked about the last time I was on. We hadn't come up to it again for the third time, but look at how you hovered on that trend line and then it backed off again. So on a breakout position, you'd watch for this trend line to really break above or price to get above here. And then I think it goes back to $2,100 an ounce very, very quickly once you get above that. And eventually, I think by the end of 2022, you're looking at around $3,000 an ounce on gold.
So Gareth, as you're a trader, you make lots of short-term movements, and you're kind of agnostic to the, let's say, the asset class that you're using to make gains in. What are some of the longer term stores of value or buy and holds that you use as it really, I don't know if you want to say an inflation hedge, but in a way a savings account?
Yeah, so and that's the key, right? So in the shorter term, I'm in and out of stocks. I'm in and out of even gold positions and gold miners and even cryptocurrency trades. You can be in and out on short-term technical levels. But again, like you said, I mean, there are positions that I like for the longer term. One is metals. Longer term, if your horizon is 2+ years out, I think you have to be long some metals. I'm also interested in cryptocurrency, although not at the current levels at a long-term basis. So sure, there's going to be bounces, but crypto is still too levered. You have to see a flush out. But if Bitcoin ever gets down to $20,000 per coin, I would accumulate some for a longer term horizon, move to 100 and 150, 250,000. And the last thing I would say is that I'm not so bullish on US stocks for the most part. There are some that are cheap, like a Viacom and a few other ones. I think I mentioned AT&T, but start thinking about investing in other countries, right? So over the last 5 years or so, we've seen a massive inflow of global money into the US because we are the golden star of investment places to be, right? Even in all fairness, even our interest rates are higher than certain areas of the world, right? Japan, Germany, and so forth. So it brings money into our economy. I do think you're going to start to see a reversal of that, where money is going to start to look to go to other countries. I think like South America is a very interesting area to start to look for growth. And I also think China's an interesting scenario because you have obviously a lot of issues with their real estate market, but they do have 1.5 billion people that the Chinese government is trying to turn into consumers. And basically the Chinese government wants to change their economy from being, basically relying on exports to being a consumer economy. And if you change it to a consumer economy with 1.5 billion people, there are companies that are trading at ridiculously low valuations because of recent sell-offs that have so much upside. Now, yes, there's the regulatory issues there, but ultimately, I'm not a believer that the Chinese government's looking to crush their own companies, right? They're trying to make sure that monopolies don't occur and stuff like that, but huge opportunities in some of these foreign entities.
So before we move on to a couple more asset classes, why don't we look at the silver chart as well, Gareth, if we could?
Absolutely. So let's take a look here at the silver chart. And silver's actually just been trading in a sideways kind of consolidation base. And what's very bullish about this, folks, is that when you have a big run up like we saw, basically going back to 2020 on the chart. So going back to March, here's your March COVID low, and you had a basic move from 11 on the SLV all the way up to about 26 to 27. From that point on, you have gone sideways, right? And what this is a lot of chop. It's known as consolidation, in this case, bullish consolidation. And again, this is usually a pattern that is digesting the big move up, getting energy to make another move up. And in fact, you could even do a measured move of where you expect the next move to go. You would take this low here, and you take this high, which again is 11 to 27, we'll say. So that's $16. And when we break out, you would assume another $16 move up. So you'd be talking potentially into the $40 range on SLV. So, I mean, there's potentially some big upside. Now, again, when is it going to break out? I mean, right now you're just going sideways. It could go sideways for another 6 months, another year. All we know is that this is your upper resistance line here. That's what you're looking for it to break. When it breaks that, it would be a go signal, and silver should have a massive, very solid move to the upside.
And that's about the $28 level?
Yeah, let me see here. It looks like around 27 and a quarter to 28. Yeah, somewhere in that vicinity. So, I mean, basically you go up there, it's going to be resistance initially, but if you can see a breakout, you have a lot of green ahead of you for just jumping on board and riding it.
Excellent. So Gareth, you mentioned a little bit ago that the crypto leverage that we're seeing makes you uneasy. I was speaking with somebody the other day that mentioned that there is a way of trading crypto that had something like 100-to-1 leverage. Does that situation is that the type of leverage that makes you nervous? And does that start to go away with more regulation in the space?
Yeah, it definitely makes me nervous. I mean, think about, some of these people that are using this type of leverage only have $5,000. When you're levered 100-to-1, think about the percentage move in Bitcoin to wipe out that entire account. I mean, it is minuscule in terms of what would have to happen. In fact, it's probably happened already with just the recent volatility in Bitcoin. So yeah, it does make me nervous. I mean, even in the stock market, there's a lot of, 2-to-1 leverage. I think some of the margin levels in the stock market are higher than they've been in history at this point, which is another concerning factor. But certainly anything, even 10-to-1 is extremely, that's volatile. That creates major issues. And the problem is that when you just get a little bit of a flush in a Bitcoin or in some cryptocurrencies, it can start to develop into a major decline when there's forced selling because of the levered position. So it certainly is an issue. If you go back to kind of 2020 or late 2019, the leverage was so little. Bitcoin was trading around 7,000, 8,000, 9,000. No one was talking about it, at least not on TV. And that was the time to look for the upside to begin. Now is the time, in my opinion, where you want to be careful until it flushes that leverage out. And again, it's not to say that longer term, I'm a huge believer, right? A huge believer in cryptocurrency and what it means for the economy and the global picture. But you just gotta let it fall first. You gotta not be a bull or a bear, let it wash out, and then look to buy it on the dips.
So the other part of my question there, Gareth, was as more regulation comes into the crypto space, do we see more of that leverage get flushed out and stop creating all that extreme volatility?
I do think that the more rules that come into the sector, you'll start seeing, especially if you're going to have scenarios where the government starts, FDIC insurance maybe on some of these crypto accounts. Because I mean, by the way, that's a huge problem right now is that, I've heard so many stories about people getting phishing attacks where they click on a link and they think they're logging into their crypto account. They're giving away their password. And then before you know it, they basically lose all their funds in their cryptocurrency account. And there's no way to get it back at that point. I mean, again, if it's the fault of the broker, the crypto broker, then you do get it back. But if it's you doing something, you don't, versus a stock account or a savings account where you would get that money back. So, there needs to be these type of things for the confidence to be built into the system. Then I think you will also see the addressing of this leverage. And again, my guess it'll be something like the 4-to-1 for day trading, 2-to-1 for stocks, where the government will say, all right, we got to be more careful here. Again, especially considering if you look at who's taking the leverage, right? It's not someone that has $5 million in their crypto account, right? They're not the ones that are levering 100-to-1. It's the accounts that are $2,000, which generally are the people that probably can't afford to lose that money, right? So again, I think the government needs to come in. It might not be the popular thing, but it'll make for a more secure and more confidence building environment. And eventually, again, I said this before, but investors in crypto should want some sort of regulation, because there is no way pension funds, which have trillions of dollars, will ever touch cryptocurrency until you get some regulation there. And then if they touch it, if they invest in Bitcoin, I mean, Bitcoin can be $500,000 or greater in no time at all if you get those type of players to start investing in it.
Mm-hmm. So when we see big deleveraging events in the stock market, why do we see Bitcoin suffer alongside it?
So I think Bitcoin does suffer because it's all connected, right? So you have leverage in the stock market. Let's just say I'm levered in the stock market 2-to-1. I am in a stock and it collapses 50%. Oh, I got a margin call. Well, I don't really want to sell that position because as an investor, the tendency is to hope that it's going to bounce back. So what do? Well, you know what? I have positions over in the cryptocurrency market. I'll sell a little Bitcoin and transfer that money into my stock account. So everything is really intertwined in our system with the leverage, and you see money flowing back and forth from stocks to crypto and back and forth. And I think that's why it's all connected. You also have the fear factor, right? So when you have a drop in the stock market and everyone's panicking, there's a tendency for that, ask questions later and just sell. And that's why you also see that kind of panic sell-off in cryptocurrency.
So why don't we have a look at the Bitcoin chart and get your analysis of that and your thoughts towards, are we seeing a topping pattern here and maybe the start of what a lot of people have called a crypto winter?
Yeah. So one thing I'd like to point out, so Bitcoin and Ether have held up amazingly well. But if you look at some of the altcoins like, Cardano or some of the other ones, even Polkadot, I mean, they are literally 20 to 40, maybe 50% off of their recent all-time highs from just a month or two ago. So you could argue that some of the altcoins are already entering a crypto winter. Now, again, Bitcoin is kind of in this interim stage where it's looking bearish, but it still has a shot. And here's your previous April 2021 high. Here we pierced it briefly. Here we pierced it again. Each time it couldn't stay above. Now that's bearish, right? Because you had a perfect opportunity here and here to have a big breakout and it couldn't hold. It tells you there was someone or some players unloading into all the small investors that were buying the breakout. So again, that's kind of a signal there. Now you've come back in. One of the things I'm noticing here is look at this little pivot low here. Notice how price is now below it and it's hammering. Like even today's candle, we're hammering right on the underbelly of that line. It's right around 59,000, it seems to be. So 59 to 60,000 is resistance. Now, for me, I look at this chart and I say, listen, unless the chart can prove that it's a real breakout, meaning it stays above 65,000 probably for a week or so, I'm going to be skeptical that we're not going to go lower. So again, as a trader or an investor, especially on a technical basis, you need charts to prove themselves before you change what the chart is showing you. Right now, the chart's showing us weakness. All right, that's what it's been for the last couple of weeks. It has to prove strength before you flip the switch to being bullish. So I'm still in the camp that you need to at least get down to 52.5. This pivot would be important. There's also a trend line right here that kind of matches up just a little bit below, but this will be your next major support. On a swing trade basis, I'm actually very interested in buying Bitcoin here, but it would just be a short-term trade. So again, 52,500 to maybe 50,000. Major support for a bounce, maybe back to 55, 56 at that point. And then I would exit for another move lower on Bitcoin.
So before we move on from Bitcoin, what factors do you look at that make you bullish on the long-term viability and real store of value play of Bitcoin?
So for this long-term store, number one, I love the fact that Bitcoin has a stated run of 21 million, right? So you want to know that it can't be a fiat currency in terms of just being printed by a government or an entity. And there are, by the way, certain cryptocurrencies that do have unlimited amounts that can be printed over time. I think Dogecoin's the biggest one to me, that every minute 10,000 new Dogecoins are printed. So there's really no difference between that and what the Federal Reserve is doing. So I think you have to look at that. That's the first thing in terms of Bitcoin that I really like as a long-term store. And the second thing is like adoption as a digital gold, to see players like Jack Dorsey, to see Elon Musk, to see other big hedge fund players starting to adopt and starting to talk about it. That's really positive. And again, you're even seeing places like JP Morgan starting to talk it up. You need to see more of that kind of go into the system where people, even average investors, start just associating Bitcoin or other cryptocurrencies with a store of safety or a way to protect against government printing of assets. And I think that's the biggest thing, right? And that's why I'm so pro, some regulation. Now, some regulation is key. You don't want them to stifle, but I don't think they will, considering how intertwined crypto is. And I'm talking about the government here in terms of regulation. But, I think I've mentioned before is that Texas now is a huge mining hub for digital assets and Bitcoin. Now there are so many jobs associated with it that it's very unlikely that the government will start saying, okay, we're going to outlaw this, because it just would create a massive issue with unemployment. So that's good. Then you want to see positive regulation where more and more of these big players and companies start saying, okay, we're going to add X amount of percent on our balance sheet of Bitcoin to kind of be the digital gold.
Excellent. Gareth, another asset class that we've seen recently that's had a lot of volatility is uranium. So why don't we go through that chart and get your thoughts on what's happening there?
Yeah, absolutely. So I'm going to look at the URNM here. URNM is probably the easiest one for me to look at right here. And really we saw that massive move up, and then you're starting to see sideways consolidation here. Now, the consolidation, just like with the silver chart, is not a bad thing, right? So it's telling you that after such a big move, it needs to digest the massive move to the upside. So again, basically this would just tell me on a technical basis that you could trade as low as this area right here, maybe back as high as here, but you're just chopping in this range. Eventually, if this pattern holds, you would expect a break higher in uranium prices, and this would break out to the upside. And again, you could do a measured move, take this low to this high and expect that kind of replication to the upside, which would be a massive move, basically from $50 to 100. And then let's say it breaks out here. So you'd go to about $150 on the URNM. But I think it's important investors hear that and they're like, oh, let me go long. I mean, you could be consolidating for the next year, just like the silver chart. So don't necessarily take it like, this second you need to be long uranium. If you want to watch it, just watch for a breakout above this area and then hop on the trade. Otherwise, I often worry that investors get into these positions and then they're sitting there not making any money for 6 months or 12 months, just waiting when there's other opportunities they could be in. But overall, the consolidation is a good thing. It's digestion. I always liken it to a marathon runner, right? So a chart that surges like uranium, it's a runner that just ran a massive marathon. Now, if you say, okay, go run another marathon, they're going to be like, oh my God, I'm exhausted. I can't do that. But if you give them some time to just rest, which is the consolidation in the chart, then they're more apt to be able to get up and run that next marathon.
Yeah, we've talked several times about, that consolidation period needing, basically building energy as you say, to make that next move higher. But while we're talking about energy, why don't we move to the oil chart? We saw a big move down last week. Towards the end of the week as well. So explain to us, the trade that you see setting up there.
So big, massive, that was actually as close to a deleveraging event as we have seen in any of the markets, even in crypto, believe it or not, where the 1 day drop for oil percentage wise was the biggest, that would be the equivalent of probably a 30% downside in Bitcoin, which we haven't seen in a long time in one particular day. So what ends up happening here, folks, is that, oil's been in this kind of grind higher for literally over a year now. And a lot of hedge funds out there, what they do is they say, okay, well, we have to make gains for our clients. So we're going to lever up, take on leverage and just tie it right to the price of oil. Because in general, we've heard, JP Morgan, some of these other big banks coming out and saying, we could see $100 oil. So they get over levered. And then when you see a drop of that magnitude, what it does is, if you're levered 5 or 10 to 1 and you get a 10% drop, they're forced to liquidate some of their positions. In fact, it wouldn't shock me if we hear over the next week about a couple hedge funds that went bust because of that oil drop. So again, forced selling created a bigger move to the downside. I picked up some long on Friday, sold it this morning, basically on the initial bounce back. It was just a kind of an understanding that when you see a deleveraging event after the weekend calms things, you usually see a snapback. But I will say this, the price action on oil today is not healthy at all. So again, if you look at the stock market, big bounce, a lot of things are getting big bounces after the declines on Friday. Oil is barely positive, up 1% on the day. So keep that in mind, is that ultimately that tells me that there's probably more downside in oil coming. I would start to get interested on the oil chart kind of right here on the USO below $45. If we could come straight into that level, look for a long swing trade right around there. And I think that would be a great level. By the way, I got to show you this. This is so cool. You guys know I love trend lines. Take a look at this trend line here. Look at the lows here, going back here, connect it to this. And then what do you get? You basically get the Friday low. So it just shows you that even with the deleveraging event, price still stopped right where it was supposed to based on the trend line.
Excellent, Gareth. So I'd like to get your thoughts on, maybe some trading opportunities in the precious metal space right now, if you think there are any. And then we can maybe contrast that after by other trade ideas that are outside the precious metal space, considering, that we are in this kind of consolidation pattern.
Yeah. So I think for me, at least, I think you want to focus on some of the gold miners after the recent drop. So for instance, here's GDX, right? GDX would give you the broad kind of exposure to a lot of the miners. The pattern is very similar to the chart on gold, which is consolidating, as well as the chart on silver. In fact, I'm trying to give you guys this channel. There you go. So basically, notice the parallel lines right there. This is the digestion after this big move up. Technically, could you go down all the way here? Yeah, you could. But at some point, this pattern breaks out to the upside. In terms of support, you might go a little bit lower. You have this little support area right here. So again, I wouldn't necessarily say this is an imminent trading opportunity. But again, if your horizon is 6 to 12 months, I think you easily see some major gains on that. We can look at Newmont Mining. Let's just take a look at Newmont Mining here. Newmont Mining is holding this area of support really, really well. I think Newmont, you buy right here around 53 to 54, and then just play this trend line. As long as it holds, this trend line gives you great opportunities to kind of play big pops on Newmont Mining as such. And we can look at the GDXJ as well. The GDXJ, which is the miners, the gold miners, the juniors. And again, just basically, it's really the same type of pattern here. You can see this trend line connects through here, which then touches right here. That's what you're looking at for a breakout. If you can get a breakout on GDXJ right here, you easily have upside almost immediately to 55, and then maybe all the way back to about 65 to 66 in the short term. So again, I think it's important to recognize that none of these are like imminent. You got to get in this second. Mm-hmm. But again, if your horizon is that 6 to 12 month outlook, you got to be looking at getting in some of these on these little dips that they're seeing.
Excellent, Gareth. How about, what are some of your favorite ways to be getting in and out of trades right now that are outside the metal space?
So for me, it would be kind of focusing on stocks that have been just beaten down, that have quality assets, quality PE ratios and dividends. So, I think I've mentioned before, Viacom is one. I mean, this stock just continues. I mean, it actually has had a good bounce off the lows. Maybe we get a bottoming tail. But again, a chart like this, I love the aspect of the buyout. They're likely going to get gobbled up in the next year or so by someone bigger that wants to combine their assets with what Viacom has. So I think that's one way to play it. I love that it pays I think it's about 2.5 to 3% dividend already, trades at a 7 to 8 PE ratio. This is in contrast to what's highest risk to me, which is these crazy tech stocks like a Rivian or a Tesla, these things that are hot that everyone's in. I want to focus on what no one likes, right? That's how I find the gems. So another one would be like CGC. Which is Canopy Growth Marijuana. I was in it a couple of weeks ago. We had this beautiful pop after a politician started talking about maybe federal legalization. And then it came right back in here. And notice how, this is a chart that everyone's going to look at and say, oh, that's nasty. I don't want to go near that. Mm-hmm. That's when I want to go near it. I want to accumulate when everyone else hates it, because what I know is this, is that at some point, another politician is going to talk about legalization, in which case you probably have 20 to 30% upside in it. And number two is that the government needs revenue, whether it's 2 years from now, whether it's 4 years from now, federally, they will legalize marijuana because they need to tax it and make the revenue. So it's kind of like a buffer zone on the short term where it's chatter that drives it up. It's cheap. And then you have this longer term thing. And then the last thing I'll throw out to you guys is something like an Alibaba. Not popular right now, which makes me like it. But look at this level that it's hitting today, folks. Going back to this level from 2018 and 2019, look at the low today and the low the last couple of days, and look at that double bottom. Technically, that is a monster area of support. And Alibaba has only grown in the last 2 years since that point, and yet it's trading at levels that we haven't seen since 2018. Again, to me, valuation, that's a great value. $1 billion, we talked about 1.5 billion Chinese potential consumers out there. It has potential off of these discounted levels. So again, basically, I'm a contrarian indicator, right, Tom? And when everyone hates something, I like it, and vice versa. And it served me really, really well, as long as you have fundamental and technical reasons behind your decision.
Yeah, I think that's a great way to look at things. And of course, that's the way we want to be able to, analyze and find stocks that the majority hates that are at those levels.
And I think the one thing I'll just mention too is that it's important to, so when you're buying stocks like an Alibaba, like a Viacom that are down significantly, the likelihood of you picking the exact low is very little. In fact, I don't pick the exact low very often. So what I do is I say to myself, okay, how much money do I want to accumulate in this position as a whole, like a whole position? So let's just say it's 100,000. So what I might do on something like these stocks is I'll put 1/4 of that money to work at the current level. If it drops 5%, I put another 1/4 in. Now I have a half position, and kind of you inch into these positions because, again, finding bottoms and picking bottoms unbelievably hard, even when you're using technicals. But if you kind of space out your entries, you get a good overall average, and then quality will eventually uptick, right? Eventually, a good quality, good valuation stock will make a move to the upside, and that's where you start getting paid out very nicely.
So again, let's say on those last two charts, you have more of a timeline of, let's say, 12 months on those.
Yeah, I think with an Alibaba, you could swing it off this double bottom very quickly in maybe 2 or 4 weeks. You could make 10, 15%. But, again, if you're someone that's saying, hey, I believe that these stocks have longer term value, I do believe that Alibaba will be a $1 trillion company. And it's, I think, trading at 400 billion right now, maybe high threes. So, I mean, there's a lot of potential upside there, maybe in the next 2 to 4 years.
Gareth, you recently tweeted that amateurs believe that there is a difference between the charts on crypto and stocks. This just shows a fundamental lack of understanding. Charts are created by investors bullishly buying or bearishly selling. All greed and fear. Trading any chart is trading human emotion. So I wanted to get you to explain to us a little bit more about this and how you try to keep perspective when you're analyzing the human emotion aspect of the charts.
Yeah, so that's the key. I mean, everyone says Bitcoin's different. I mean, we've heard about that for many assets over the last, at least since I've been trading for 20 plus years. And it's really, so when you look at a chart and price action, right, the ups and downs, how is that? Why is that occurring? Well, when it's going down, there's more sellers. People are bearish. They're fearful. And when it goes up, people are bullish. They're greedy. They're thinking it's going to go up even more. So they're buying and pushing it up. And again, that's what creates a chart, whether it's in stocks, whether it's in cryptocurrencies, whether it's in commodities. And you have to understand that. So therefore, technically, you should be able to trade a double bottom on crypto, just like you trade a double bottom on stocks. All right. And now, people will say, well, what about on-chain analysis when it comes to cryptocurrencies? And yeah, on the longer term, sure. I mean, if you look at the next 10 years, the next 5 years, on-chain, just like fundamentals, like if Google's going to keep on making more money, it doesn't necessarily mean that a panic in the stock market won't crush it now. But yeah, over the next 5 years, if they keep making more money, their stock price will go up. But again, for us that are looking for opportunities, we focus on entry, which is now, which is short term. So we abide by that fear and greed side of the charts.
Excellent, Gareth. I think that's a good place to wrap up here. Is there anything else you'd like to mention before we do?
Just that you guys can follow me on Twitter at Gareth Soloway. And I just launched verifiedinvestingcrypto.com. It's only crypto. So stock trades. In fact, we're not stock trades, cryptocurrency trades. In fact, we just bought Polkadot yesterday, sold it later in the day, in fact, for over 10%. It's kind of the swing trade of crypto where we're just technical. There's no FOMO. There's no panic emotion. It's strictly trading just off charts like we've been talking about. So I hope you guys check it out. And thank you, Tom, so much.
Of course, Gareth, anytime. And of course, your other website is InTheMoneyStocks.com, right?
Absolutely. Thank you so much for having me. It's been such a pleasure.
Absolutely, Gareth. Anytime. Thanks for your time. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.